Have you ever wondered how a brilliant tech startup can capture the market, secure massive partnerships, but still find itself fighting for its very life on the public markets a decade later? Well, today we're unpacking one of the wildest, grittiest survival stories in the sports technology space. We're talking about Game Your Game. They were a pioneer in golf analytics that essentially created an entirely new product category long before sports tracking was even mainstream. This company went from literally $0 in the bank to securing an accidental presidential endorsement, and now they're in a ticking clock survival mode. It's a fascinating and honestly sometimes terrifying look at the reality of building a startup. So let's get right into it. To really understand the DNA of this company, we have to start with the founder, John Maguire. He was a former software engineer at Nortel, but he also had this deep, specialized background in clinical sports psychology. Maguire had a brilliant vision for an automated golf tracking platform called ActiveMind Technology, which is what eventually became the GameGolf system. But building hardware from scratch, it is incredibly difficult and notoriously expensive. He found himself completely broke, putting massive strain on his personal life just to get a prototype off the ground. Just look at this raw, unfiltered quote from Maguire reflecting on those dark early days. He said, "If you've 2 kids, a wife, and no money, then you have no choice but to succeed." That right there is the absolute essence of the startup grind. It shows the immense behind-the-scenes personal stakes attached to the tech products we use every day. So, how does a founder on the brink of giving up completely turn things around? Well, it starts with an unexpected Oval Office endorsement. Let's look at how a desperate late-night plea turned into an unbelievable stroke of luck that literally put this company on the map. Maguire was down to his last dime, completely running out of options to keep the lights on. During a dinner with an enterprise advisor, he openly admitted he was broke and nearing the end of his rope. The advisor just told him he'd find a way. So Maguire opened his laptop right then and there and fired off a Hail Mary email to the prominent venture capitalist Chamath Palihapitiya. He boldly promised the company was going to succeed no matter what and dropped names of major pro golfers who were ready to endorse the product. And this perfectly illustrates the razor-thin line between failure and massive success in Silicon Valley. Just 20 seconds after hitting send, Chamath replied with 3 simple words: "I'm in." That single, desperate email secured the critical funding they needed to officially launch the GameGolf Classic device in 2014. The initial launch was a solid success, establishing a brand new category in sports tech telemetry. But then, things went completely, unexpectedly viral in a way no marketing budget could ever buy. In August 2014, President Barack Obama was photographed wearing the distinct red GameGolf tracker on his belt while playing around in Martha's Vineyard. This was a totally organic, unscripted moment. And that unexpected endorsement triggered a massive wave of global consumer demand practically overnight. Suddenly, every amateur golfer out there wanted to track their shots just like the president. The hype was so intense that demand temporarily outpaced their entire production capacity, causing a massive backlog. But as we see over and over in the startup world, going viral doesn't magically solve everything. It can actually accelerate underlying business model problems that were previously hidden. Which brings us to the hardware economics trap. This is the brutal reality of manufacturing physical products, and something a lot of software founders learned the hard way. GameGolf was undeniably the early pioneer here. They set the standard for everyone else. They even secured massive, highly coveted partnerships with the PGA of America and the Golf Channel. They had the brand recognition, the early market share, the media buzz, the whole shebang. But despite all of that, they fell right into the classic hardware trap. Building physical devices requires massive upfront capital, incredibly complex international supply chains, and really high per-unit production costs. As that initial viral hype started to cool off, these manufacturing complexities began to steadily erode their early financial success. They got caught in this vicious cycle of margin degradation, where the sheer cost to produce and support the physical tech was eating up all their profits. To see exactly how bad this margin compression got, just look at the trajectory here. Their gross margins absolutely cratered from a very healthy 84% in fiscal year 2024. By fiscal year 2025, that margin had collapsed all the way down to a staggering, unsustainable 9%. You simply cannot sustain a growing tech company, pay software engineers, and fund new R&D on single-digit hardware margins. The underlying shot tracking technology was brilliant, but the fundamental business model of selling hardware boxes was failing them. So, to survive this mounting financial pressure and keep the technology alive, the company had to get incredibly creative. This sparked an era of corporate spin-offs and divestitures. What followed was a dizzying decade of restructurings, strategic acquisitions, and complex ownership changes. Let's map out how the original GameGolf brand evolved into its current corporate form today. Tracing this chaotic 10-year period, it all started with that legendary GameGolf Classic launch back in 2014. But as the physical hardware model struggled, investors realized the underlying intellectual property and the software were the actual valuable assets. By 2023, the underlying tech was caught up in a broader acquisition and restructuring by a data company called Inpixon. Then, the assets were continuously shuffled through various holding companies, including a formal divestiture to Graffiti LLC in 2024. Finally, the core golf analytics business was cleanly spun out into its own independent entity. That standalone entity is what we now know today as GameGolf Inc., which aggressively set its sights on entering the public markets in 2026. This incredibly complex corporate journey ultimately leads to a zero-proceed direct listing. In July 2026, GameGolf officially made its public market debut on the Nasdaq exchange. But let me be clear, this isn't your traditional celebratory bell-ringing victory lap where a hot startup raises hundreds of millions of dollars. Instead, this public debut is a high-wire survival act designed to keep the lights on and facilitate a massive strategic pivot. Trading under the surprisingly catchy ticker symbol GYGY, this debut was strategically structured as a zero-proceeds direct listing. What does that actually mean for a cash-strapped startup? It means this is purely a resale registration for existing stakeholders. The company itself is not raising a single cent of new cash from the shares being sold on the open market today. Only the existing registered shareholders are permitted to sell their stock. For a company trying to aggressively commercialize a brand new product, entering the public market without an immediate cash injection is a monumental risk. To truly understand how fragile this current financial situation is, we have to look closely at their current scale of operations. Consider that their entire top-line revenue for fiscal year 2025 was roughly $58,000. Yes, you heard that right. A publicly listed Nasdaq company generating less than $60,000 for the entire year. And almost all of that tiny revenue figure was derived from heavily discounted sales of their new device during a closed beta testing phase. This tells savvy investors that despite a 10-year history in the industry, GameGolf is currently operating very much like an early-stage startup trying to find product-market fit all over again. Now juxtapose that microscopic revenue against the massive liabilities on their balance sheet. As of March 2026, the company was facing a severe working capital deficit of nearly $1.9 million. They owe significantly more money in the short term than they actually have on hand in the bank to pay their bills. This creates an incredibly tight liquidity bottleneck. We are talking absolutely zero room for operational errors here. Looking at the metrics from early 2026 really puts this squeeze into perspective. They had just over $286,000 in cash and equivalents remaining. Meanwhile, their current liabilities were sitting at a massive $3.3 million. With a steady monthly cash burn rate of about $110,000 just to keep operations running, the runway math gets very scary, very fast. In fact, the financial situation is so tight that their auditors officially issued a going concern warning. This essentially means the company's survival rests entirely on their ability to draw from a highly restrictive $40 million Series A facility. They have to execute their next product launch perfectly, or the clock simply runs out on the whole operation. So this leads to the ultimate question for any tech entrepreneur watching this right now. How does a company with virtually zero commercial revenue survive? Well, it's time for the AI SaaS gamble. It requires a massive, high-stakes strategic pivot that aims to fundamentally change how they make money. They are completely abandoning the old way of doing things and literally betting the farm on software. The old model was all about low-margin, one-off hardware sales, which we already saw as a dangerous trap that destroys capital. The new model? It's the absolute holy grail of the modern tech industry, and it's something investors love. They are transitioning into a high-margin, recurring software-as-a-service subscription ecosystem powered by artificial intelligence. Instead of just selling you a piece of plastic for your belt once, they want to sell you continuous, AI-driven performance analytics every single month. They are pinning all of their survival hopes on the successful rollout of this brand new device, the GameGolf KZN. And this isn't just a basic GPS tracker anymore. It is a highly sophisticated piece of tech. The KZN leverages advanced edge-computed neural networks and something they call the Smart Caddy Engine. It acts as a dynamic digital coaching dashboard to give golfers highly predictive, real-time insights right there on the course. It is quite literally like having a professional PGA caddy in your pocket, completely powered by deep artificial intelligence. Now, you might be wondering, with all these financial problems, why do sports tech enthusiasts and institutional investors still care about this company? It all comes down to their massive, hidden competitive advantage, the data moat. Over the last decade, GameGolf has quietly built a proprietary database containing over 300 million individual, highly detailed shot records. They have tracked and analyzed over 3 million full rounds of golf globally across every possible skill level. In the modern world of AI, high-quality, proprietary data is the ultimate currency. This massive historical dataset is an absolute goldmine for training their edge-computed AI models to be smarter than anything else out there. It's a fundamental asset that a brand new competitors simply cannot replicate overnight, no matter how much venture capital they manage to raise. But having great data doesn't pay the bills on its own. Everything for the future of this company hinges on a single critical date: the successful consumer launch of the KZN platform, aggressively targeted for August 18, 2026. They price the hardware at about $300, but the real play is the mandatory SaaS subscription model attached to the app. They desperately need to convert all those early beta testers and legacy hardware users into paying, recurring software subscribers. If they can definitively prove that amateur golfers are willing to pay a monthly fee for AI analytics, the whole financial narrative of the company changes overnight. Which brings us to the final high-stakes reality of GameGolf today. With their Nasdaq listings securing their public footprint, but providing absolutely zero immediate cash, they are walking a dangerous financial tightrope. We really have to wonder, will this ambitious AI subscription pivot generate enough capital fast enough to satisfy their creditors? It's a classic startup tale of brilliant innovation battling incredibly harsh economics. If this AI gamble works, it could redefine sports telemetry forever. But if it fails, will GameGolf become just another cautionary tale of hardware hubris? Keep a close eye on that KZN launch. The clock is officially ticking. GameGolf has just hit the Nasdaq capital market under the ticker GYGY. And honestly, we're looking at a serious anomaly in the financial markets right now. It's a highly speculative, pre-commercial sports technology company heavily leaning into AI, and they've just entered the public sphere through a direct listing. The structure of this listing, the actual financial reality of the underlying business, and the highly restrictive debt covenants currently keeping the lights on, well, they paint a fascinating, incredibly high-stakes picture for investors. Let's look at the numbers. The immediate paradox of this public debut hits you right away. By utilizing a direct listing of just over 16 million existing shares, rather than a traditional underwritten initial public offering, GameGolf is raising exactly $0 in new primary capital. Zero. There is no underwriter here, no massive roadshow drumming up a huge cash infusion, and absolutely no new shares being issued to shore up the balance sheet. Instead, the company is establishing a public trading market entirely to provide liquidity for its existing private shareholders and, to elevate its corporate profile. To really grasp the sheer scale of the financial risk profile we're dealing with, we have to look at the top line. For the entire fiscal year of 2025, GameGolf reported revenue of just $58,505. Now, yes, technically that is a 293% increase from the prior year, but on an absolute basis, it clearly tells us this is still a pre-commercial entity, and that tiny bit of revenue was entirely driven by deferred releases tied to discounted beta program hardware sales. So put that into perspective. You have a company carrying the heavy public reporting burdens of a Nasdaq-listed entity, but operating on the revenue footprint of a local small business. But let's take a look at the strategic bull case, the SaaS margin pivot. To understand the underlying value proposition here, we have to look at a radical transformation of their business model. GameGolf is actively attempting to pivot away from being a low-margin hardware manufacturer, morphing into a high-margin recurring AI software as a service ecosystem. The financial mechanics of this pivot are drastic. The legacy GameGolf model relied on a one-time hardware sale at $199. That's a model that saw gross margins compress violently down to just 9%. The new commercial strategy, though, introduces a $249 hardware purchase paired with a $29 per month recurring software subscription. That is $348 in annual recurring revenue per user. If they can execute this, it theoretically builds the kind of predictable, high-margin cash flow that institutional investors absolutely demand. Now, to weigh that theoretical SaaS upside, we need to analyze their intellectual property data moat. An AI-driven subscription is only as valuable as the neural networks powering it, right? And in the world of artificial intelligence, data is the ultimate currency. This is exactly where GameGolf claims a massive proprietary advantage with their Smart Caddy recommendation engine. This technological foundation creates a very distinct barrier to entry. Since 2014, their legacy hardware has quietly been accumulating what we call data gravity. We're talking over 300 million individual golf shots tracked across 3 million rounds, mapping out 36,000 global courses. This deep historical context trains their edge-computed neural networks to provide highly personalized recommendations. Coupled with an international patent portfolio securing their methodologies all the way through the 2030s, the technological asset base here is undeniably substantial. However, if we shift the narrative to a forensic accounting perspective, the balance sheet red flags become impossible to ignore. The reality is, the balance sheet tells a much more precarious story than the technology does. Transitioning to a SaaS model requires significant capital for customer acquisition and software development, and the current capitalization structure here is severely strained. Analyzing the Q1 2026 balance sheet cleanly outlines an immediate liquidity crisis. The company holds $1.44 million in total current assets, against a mounting $3.32 million in current liabilities. Even more critically, as of March 31st, they had just $286,087 in cash on hand. When you factor in a monthly cash burn rate of roughly $110,000, well, you can do the math. The mathematical runway for this company to survive without external intervention is remarkably short. The crucial operational roadblock staring them down is a crippling $1.87 million working capital deficit. And it's exactly this severe capital deficiency that triggered an official going concern warning from their independent auditors just ahead of their public debut. It's a stark, unavoidable reminder that technological promise simply cannot outrun immediate financial obligations. Compounding these balance sheet risks is what we might call the insider control trap. When evaluating any microcap technology listing, analyzing the capitalization table is absolutely paramount to understanding who actually pulls the levers of power and how minority public shareholders are prioritized. A quick look at the cap table here demonstrates a severe concentration of power. A single insider, former CEO Nadir Ali, through his family trust, and Graffiti Group LLC, holds a commanding 64.52% of the voting control. This absolute majority allows GameGolf to operate with controlled company exemptions on the Nasdaq, which literally means they aren't even required to maintain a majority of independent directors. For the minority public investor, your voice in corporate strategy is essentially muted. And this dynamic leads directly to what analysts closely monitor: asymmetric capital utilization. Take their B2B distribution mandate with golf suites, for example. GameGolf committed $500,000 of its critically low public corporate cash reserves to golf suites for co-marketing. But concurrently, Graffiti LLC, that insider-controlled entity we just mentioned, executed a private transfer of GameGolf shares for $4.5 million in Golf Suite's equity. It's a highly complex related party swap, where public company cash is being deployed while private equity value is exchanged by insiders. This brings us to the make-or-break covenant of the company's entire financial architecture. With zero proceeds from the listing, an ongoing cash burn, and a massive working capital deficit, the entire survival of the entity basically hinges on a single debt facility that's currently keeping the lights on. But the conditions of this Street Roll Capital $40 million Series A preferred debt facility, they are highly restrictive. To even draw down on this crucial funding, GameGolf must maintain a minimum public market capitalization of $20 million and maintain $250,000 in daily trading volume. Furthermore, both Streetville and the insider-controlled Graffiti retain explicit veto rights over any future debt or equity issuances. So, if the stock price slips or if trading volume dries up, this funding lifeline is immediately severed. Which leaves us with the ultimate question framing this entire public debut. We have an undeniable intellectual property moat built on billions of data points and a highly lucrative theoretical SaaS pivot that could, in theory, generate massive margins. But stacked directly against that is a severe liquidity trap, an auditor's going concern warning, and debt covenants that demand flawless market performance from day one. It is a true high-wire act of corporate finance. So what do you think? Will the AI data moat generate enough recurring subscriptions to satisfy those debt covenants, or will the mathematical toxicity of the balance sheet pull the company under before commercialization can even take hold? It's going to be a fascinating scenario to watch unfold.